I mean, the whole point of, all right, so I've managed to find that, okay, so remember we were talking about the correlation, I couldn't make that page work. That's because I just refreshed the page and it was such a stupid thing, I could have done it earlier. Okay, now you see the correlation between the oil price and the S&P 500. The blue line is the S&P 500 and the red line is the oil price, okay? So can you see that there is a fair bit of correlation? There's a fair bit of lockstep movement happening, and especially the last part I was talking about here. This is the entire discussion of why many funds have difficulties, because suddenly when you have a market crash, everything comes crashing down together. You can see pretty much the bottom in the oil price and the stock market is almost perfectly coordinated, okay? The top is not perfectly correlated because the stock market, I think, peaks a little bit earlier and the oil market peaks a little later. But this is what I wanted to show you, that you can see how, so as I said, once again, most important thing in correlation is do not get carried away by this, because there is a tendency among market participants, because everyone wants to show that they are very smart, okay? So they'll come to you with models and all, they'll show you, look at this beautiful correlation between the oil price and the S&P 500. Based on this, I've built this predictive model, and therefore, but one thing you should be aware, and nobody's going to tell you that these things are the markets are very unstable. Okay, so this is not like modeling in physics. So what you should be aware of is, that's why one of the reasons why you're given these projects with live data, you should get a first-hand feel of how market prices actually move. Okay, and so what you should be aware of is these are very unstable systems. The markets are the economy as well is a very unstable system, because everything is driven by human expectations. Everybody's expectations is getting reflected in the market prices and economic data, unemployment, production, capacity utilization. Everything is driven by human expectations. So therefore, these things are very unstable. You'll find that they work for a while and then suddenly, boom, you don't even know why it's happening, and suddenly the correlation will go. Okay, so that's what you have to be aware of. So trust it, but trust it only for a while and just be aware of this risk. Okay, so this is the point that we wanted to discuss. Now we go back to yesterday's discussion, which is we were covering debt capital markets. All right, so there's some other stuff that we have to cover we still haven't finished. We were discussing the importance of the junk bond markets, right? So what's the name of the person I mentioned to you who basically effectively invented the junk bond market in the US? Michael? Michael, that's it. Yeah, so Michael Milken. Okay, so if you go on YouTube, there's he's founded an institute called the Milken Global Institute, I think. It's somewhere in I think in LA or somewhere. They have some very interesting videos. If you go and query on YouTube, if you go and query for Milken Global Institute, they have some very interesting discussions on global markets.
There was some other person in the internet, Billy?
Well, there were many people involved, but Michael Milken is known as essentially the man who gave birth to the developed the junk bond market. And what you should understand also is how these things are developed, how innovation happens in capital markets. That essentially a guy goes and he gets this idea that if I can create demand for junk bonds, I can sell a lot of junk bonds and I can use that to finance takeovers and other kinds of activities, because there was a lot of slack in corporate America at that time. So they were able to sell these junk bonds, but obviously you have to first create demand for the product. Okay, as you know, it's in marketing, you have to create demand for products. Otherwise, all this, whatever product you sell, if you can't create demand for it, there's no business. So a couple of other points we need to understand in junk bonds. As I said, the importance of junk bonds is, so these firms like KKR, what I've mentioned here, KKR, Kohlberg, Kravis, Roberts. This is Kravis, Roberts. Okay, these guys are the pioneers of the LBO market, the LBO boom. Okay, so these are the guys. So that film that I told you about, Barbarians at the Gate, which you can find on YouTube. Okay, that was actually the takeover of RJ and Nabisco, which was masterminded by KKR at that time. Okay, that time they were called Kohlberg, Kravis, Roberts. And so that's one of the stories. So this is the height of these are kind of like long-term case studies which you can read to understand how financial markets develop and how innovation happens. Okay. All right, so all this stuff we've covered, tips, real rate, markets expectation on inflation, that's very important, and the connection to monetary policy, okay? Remember the central bank monetary policy, one of the very important goals in most countries including India, is that they want to keep, and in India it's more important because in India our central bank has what, a dual mandate or a single mandate, okay? So single-minded focus on inflation control, okay, around the 4% level. So plus minus 2, okay? So therefore, in India, it's very important that, but unfortunately, our debt markets are not well developed. So we don't, although we do have tips in India, but they don't trade actively. So you don't get, charts and data and stuff like you get in the US. So this very important connection between monetary policy and inflation expectations. And how do you find out the market's inflation expectations? Who's going to tell us, Sandhya? Are you going to educate us? If I'm in the US, where there's an actively traded market for all these different types of securities which we looked at yesterday, you have the straight nominal bonds, okay, the straight bonds of the treasury, and you have other types of bonds which I don't want to give you a clue. So how, if I want to look at 10 years, if I look at the 10-year maturity point in the US, and I want to find out the market's inflation expectation over 10 years. What is the market's inflation expectation over 10 years? What process do I go through to find that answer? Is my question clear?
Yes, sir.
I'm asking, is it clear to Sandhya? Yeah? Okay, so what is the answer? Tanvi, what is the answer? You understood my question? If I'm operating in the US markets and I want to know what is the market's inflation expectation for the US economy over a 10-year period, okay? So what is the market data telling me about the aggregate expectation of the market? Okay, so what steps do I take? I mean, what steps do I follow to find that answer? Yes, first I take the nominal treasury for 10 years, okay, fine, and then where do I find the real rate? So the first part of her answer is correct. But Lakshay, can you help her? Complete the answer. Question, you didn't listen to the question.
I didn't listen to an answer.
You should be listening to everything. So question is, how do I find out if I'm operating in the US market, in the US debt markets, and I'm looking at the 10-year period, okay, 10-year maturity, and then I want to find out what the market's inflation expectation. This is an important question, right? What is the market expecting for inflation over 10 years in the US economy? Average annual inflation rate over 10 years. How do I find out that figure? If I want to know what the market's expectation is for US inflation for 10 years, okay, how do I find out that figure? Is there a set of steps I can follow to find that answer from market data itself?
First, the real rate, like she said.
Where's the real rate? How do I know the real rate?
The nominal rate minus the.
No, but that's what I'm trying to find out. You are introducing circularity. When you program in Excel, if you put in circular references, that's what you're saying. I'm asking you, how do I find out that is my unknown. My unknown is expected inflation, market's expectation for inflation. So how do you're putting in circularity into your definition. Okay, anybody, Chadda, can you help us? So what were we doing yesterday when we were covering the material? Nikhil, does your phone tell you the answer? No? Any idea? Who will help us? Ridhima? You understood the question? So, what will be the answer?
So first we take
Be quiet here. Yeah.
nominal rate is the real rate plus expected inflation.
No. Again, you're introducing circularity into your answer. I'm asking you, how do I find out expected inflation for the 10-year period in the US economy? By looking at stuff that's available in the market, looking at data that is available in the market, okay? How do I find this answer? If I want to know what the market is expecting in aggregate, for the market as an aggregate is expecting for inflation, average annual rate of inflation for 10 years in the US market, for the US economy, how do I find out this answer? By looking at available market data in the US debt markets.
So the real rate of return is derived from tips.
Okay.
Tips is those securities which already include the expected inflation. As in, if if the rate is 6% and the expected inflation is 5%, in nominal rate of return, we will get 1% return. But in case of tips, we get the 6% only. So it already includes the expected inflation.
Okay, fine. We can come back to the definition of tips a little later. But you're saying that the real rate will come from the tip yield. Okay, and then how do I get to my answer? My answer is I want to know what the expected inflation is. So I've got the tip yield from the real rate. Then?
So the nominal rate of return minus real rate of return derived from tips will give us expected inflation.
Okay, good. So finally we have the answer. The nominal rate of return you can get by going to the US Treasury page and find out the yield on the US nominal 10-year US Treasury. Or you can just point to, you can just add here, you can just enter, okay, here you can just enter TNX and you can just figure out it's about 2.72. So TNX is the US Treasury yield. So it is written like this, but actually this means 2.72. Okay, this is the index. So you can find out what the US nominal 10-year US Treasury rate is by just querying US Treasury yield curve in Google. Okay, or you go to the US Treasury homepage and then you find out what the tip yield is. So you subtract the tip yield from the nominal Treasury yield and then you get the expected inflation. Is everyone clear now?
Yes, sir.
So
Okay.
how can we find it in India?
In India also, theoretically, remember the theoretical process will not change. The theoretical process does not change. The only problem that you're going to face in India is because the tips is not trading actively. We do have tips. We did issue tips, okay? But they don't trade actively because our debt markets are really badly, very poorly developed. So we don't have an actively traded debt market, so and a liquid debt market. So theoretically, the process does not change. That is one of the reasons why I'm teaching you. Some of you might wonder why we are so focused on US markets, because the theory doesn't change. The only thing that's going to happen in India is that you will find it difficult to get the tip yield in India. You won't get the data. Here you can just go to the US Treasury website and find the tip yield. You can just check that St. Louis Fed page and check the tip yield, which I showed you yesterday, the chart of the tip yield. Because the market is trading actively, it's very liquid, so that information is being generated and disseminated. Sometimes you might have to pay for the information, okay? But here also, I'm sure if you get a Bloomberg or something, you might get some outdated tips data, but the tips is not trading actively in India.
So then how can we, for now?
Technically, you have a problem in the sense you might not get the data, but at least you're here to get theoretical clarity. So theoretically, when you do this process in India, it doesn't change anything from the theory point of view. You will still have to take the nominal rate. You'll have to still take the nominal rate and subtract the tip yield. Is everyone following? Is everyone clear about this? That when you have to do this in India, the theory does not change in any way. Is that clear?
Yes, sir.
You still have to follow the exact same process, okay? Which is you find out what the nominal yield is for that maturity period, whatever your discussion is. If it's a 5-year expected inflation that you're going to find out, then you look at the 5-year Government of India bond, okay? Then you look at the 5-year tips, so you subtract the tip yield from the Government of India nominal bond yield, and that's your expected inflation for 5 years. Now, of course, you might not be able to get the data for tips for 5 years. That's a different problem. We don't need to worry about that kind of problem in an MBA program. That you worry about wherever you are in your job, those guys will make sure that you get the data. Because they'll pay for some provider service or something, you'll find the data somehow. Okay, is this clear? Dipanshu is not very satisfied, but you understood, right? In an MBA program, we are concerned with giving you the theoretical clarity. So the actual implementation problems might differ. That's why, anyway, in any case, all of you should be very focused on the US economy because it's the biggest, most developed economy in the world. So by observing what's going on in the US, you get to know what a developed economy looks like. Okay, and the stuff that is there in the US today will probably come to India 10 years later or something like that. So that's how development happens. So it's always a good idea to follow the US. And for your lifetime, I can guarantee you, all this garbage that you hear in the business press that China is going to overtake the US, total garbage. Okay, it's not going to happen.
India will take over US.
That also is difficult, but not with the kind of policies we are following now. We could come very close, but not with the kind of policies we are following now. No way. That's why we are stuck. We need to be more free market oriented. Otherwise, prosperity doesn't come to you.
Which policies?
Free market policies, just free up everything. We are very socialistic policies. Okay, so essentially what I would recommend, if it's very simple, if you want to have See, India can enjoy double-digit growth for 15 years with less than 4% inflation, but that requires aggressive, radical free market policies, which means you have a convertible currency, no capital controls, cut import tariffs down to 1% everywhere. Nothing will happen. You will see prosperity like you can't even imagine. What manufacturing? One second, just use your brains. If somebody, one second, if Renault has to make cars, Renault has to sell cars in a market as big as India, do you think they're fools that they're going to manufacture in Spain and ship it all the way here? If they know that they, one minute.
The custom duty will almost be double of the price. But if you talk about components, not the government.
Nothing. No. 1 minute. Why should we accept the premise that we cannot manufacture competitively with any other country in the world? All of it is connected. These are all socialist ideas which have been sort of infected. You guys have been infected with these socialist. There is no country in the world which has ever achieved economic prosperity without free market policies. Not possible. Not possible.
China, the government imposed.
China is a very artificial economy. I wouldn't want to comment on China. See, I don't believe anything that comes out of China. Okay, China, 1 minute. China's GDP is supposed to be 14 trillion. I don't believe it. I think it's more like 7.5 or something like that. All of their data is suspect.
So even their material.
Everything is suspect. I just want to leave China out of the discussion. China is not part of any economic discussion on policy discussion because you don't know what's actually going on in that country.
But we have to keep in mind China while making our policies.
No. I'll say there's a long. Okay, let's not get into this discussion. But you should be 1 minute.
Sir, it is very important.
Okay. So everybody thinks this is an important discussion. 1 minute. You think it's important because that means that you don't have to rack your brains over expected inflation tips and so it's much harder. Here you can just sit back and relax while 2 or 3 people are talking, and then Nikhil will work on his phone. Okay, so the point is, okay, let me just give you the gist of the policies. Okay, I'm not trying to brainwash you, but in India everybody is a socialist. Okay, whether it's Congress, BJP, they're all socialists. Okay, so now therefore I think it's important. I don't want to brainwash you with my ideas, but I think it's important for you make up your own mind, but I think it's important for you to be exposed to the idea of radical free market policies, which you won't hear in India because everybody here is a socialist. Okay, so we have all these bizarre ideas. See, we've been following these stupid policies from the independence for 70 years. Where has it gotten us? If you look at India, look at the potential of this country, in 70 years, we should have already become an economic colossus. We should be very close to the US economy by now. Okay, we should have been. But we followed stupid socialist policies since independence. That's why we are here where we are. Okay, even today, just free, can you imagine, look at the dynamism of the Indian business community. Okay, if we can compete with everybody, we can compete with anybody. If we are put in that situation, we can compete with everybody. So the point is that you have to first understand that you can never achieve prosperity anywhere in the world without free market policies, because free markets create competition. Competition drives down prices. It leads to all kinds of innovation. Input costs go down for other industries. So without free market policy, there are some caveats. Okay, like for instance, Donald Trump has brought out some very important points that you can't have free trade in things like steel and aluminium because those are very important for defense. So what he's doing is, you see that free trade, he's a free trader in general, but that's a very important point, I think, which he alone has brought out, which I've also learned actually. I also was a total free trader, but then I realized that steel and aluminium, you can't allow Chinese steel companies to come and dump here and destroy your domestic steel industry, because tomorrow if you have to go to war, steel and aluminium is essential for war. Okay, so you need to have some kind of protection for steel from foreign countries. But if you look at big countries like India, this is another reason why we should have free market policy. Look at the size of the Indian economy. We are not like Switzerland or something like that, a tiny country. If you have free market policies, if you kick the government out of the way, the government interferes in every sector of the economy. If you kick the government out of the way, just imagine in India itself, steel you think there's going to be only one steel producer in India?
No.
So it's such a big economy. There'll be enough competition in the domestic economy itself. And you have things like the Competition Commission of India to make sure, they came out with heavy fines on the cement manufacturers. The most important arm of the government actually, I think, is they should scrap every part of the government except for defense, law and order, environmental protection, and Competition Commission. That is the most important thing. The CCI should make sure that there should not be any collusion among steel manufacturers to artificially raise prices. So it's such a big economy. If you leave it to natural forces with competition law control, we will anyway have many players. There'll be enough competition. Okay, so there won't be any kind of risk. That's why I say the CCI is the most important arm of the government.
Investment, private players don't have such amount of investment with them because...
No, but if that's what I'm saying, you bring in foreign capital. See, this is why you bring in foreign capital, you have convertibility. 1 minute. 1 minute. You have convertibility. That's one of the major problems in India, capital controls. Okay, show me one developed country with capital controls. Very few. China, I don't consider, China is not a developed country according to me. It's just we don't know what's going on there basically. I don't trust any of the numbers. We don't know anything about what's going on.
Many countries depend on China.
No, they may depend on China, but there's also all kinds of stuff like they're putting chips up. I mean, I want to just leave China out of the discussion because it's not a, see, it's 1 minute. 1 sec. China is a very artificial economy. First of all, you can't trust the numbers, okay? You can't trust the numbers. You don't know what's going on. There is a lot of, I know that they're doing a lot of their policies, there's a lot of IP theft. You know what's going on in the US trade talks right now? One of the major issues is IP theft because they have forced companies to set up joint ventures with Chinese companies. No company can operate in China without a 50-50 joint venture. And then they force you to give up the IP for the technology companies.
Yes, sir.
Okay, so the whole build-up of China has been very artificial. What they have done is they have brilliantly exploited the stupid Western companies who were, they were in awe. Oh, China, biggest market in the world. Let's go into China at any cost. Okay, so there are many companies who have made this mistake and gone in, and the Chinese have been brilliant at exploiting the world's fascination with China.
That is
okay.
China now.
So they are very crafty. I'm not denying but 1 minute. That's a very artificial economy. You cannot build economy. That's a very artificial economy because the government plays a very big role in the economy.
Yes.
Okay. The government can switch off and switch on credit creation by instructing these state-run banks to lend money or not to lend money, right? So it's a very, very artificial economy. So I don't want to have it. You can have a discussion with Australia, Canada, US, Europe. These are all normal economies, Switzerland, whatever you want to talk about. But China is a very, very artificial phenomenon. Okay, so I don't want to come up with economic policies based on what has happened in China. So that's one of the points. Okay, but yeah.
For example, if I want to set up a manufacturing unit of component in India,
yeah,
my cost of production is much more higher than that of China.
First of all, it's not much more higher. It's much higher.
Much more higher. Much more higher.
English. Okay. No, 1 minute, one sec. Just be careful. There is also a trend that you guys should be aware of, that costs of production are going up in China as well. Many people are moving to Vietnam. 1 minute. Let me finish. 1 sec. Many people are moving to Vietnam as well. Many people are moving manufacturing to other countries like Vietnam. But the point is that, listen, the point is that your long-term economic policies, these are just cyclical shifts and things that happen. Okay, some countries, okay, eventually they become more prosperous, then the wage rate goes up. These are cyclical things. Your long-term economic prosperity is not going to live and die on the basis of these cyclical shifts. Okay, there will be some movement of value chains from here. Production will shift from here to there, as is happening now. China is losing a lot of production. They're going into Vietnam partly because of the trade conflict with the US. These are the cyclical up and down shifts. Okay, you need to have a long-term commitment to free market because you have to first understand the power of free markets to create prosperity. Simply because free markets lead to competition, and competition leads to innovation. Everything, this is how economic growth happens, okay? So the less you have, you have to have a long-term commitment to this idea, to this philosophy, which is virtually non-existent in India, okay? Virtually everybody, even the economists, everybody here is a socialist, okay? So they don't have, what it means to be a socialist is that they don't have any concept of the power of free markets to bring prosperity. And they think that what we are doing, we are doing great, we are doing better than Pakistan. That is not our destiny. Okay, so we should have been, by 70 years, we should have been an economic and military superpower by now. In 70 years. We've not been there, we've not come there because we've been following stupid policies. If we had followed radical free market policies since opening, look at Singapore.
Yes.
Such a tiny country with what did Singapore do when they started their country, when the whole thing started in 1965? So they had nothing. So Singapore, look at Changi Airport, Changi Airport has become the world's best airport 10 years in a row at least, okay? What did the Singapore government say to Changi Airport? No protection. You compete with Jakarta, you compete with all the other airlines, okay, Bangkok and every other airport. The government will not give you any protection. If you can't compete, you will not have a good airport. Okay, you don't have. So Singapore Changi Airport, although it's majority owned by the government, because the government has followed free market policies in hiring, the government in Singapore, the government pays private sector salaries. They look at private sector salaries and they hire the best and the brightest from the private sector by paying private sector salaries. A Singapore minister earns $1 million at least. Okay, at least when I was there a few years ago, they were already earning $1 million, but they don't get any other allowances. Okay, so so this is what they do. So Changi Airport, how did it become the best airport in the world? Singapore has nothing. They have no resources. Okay, so and then how did Singapore Airlines become such a major brand? Okay, until a few years, until these Arab countries have come up with Etihad and all these things. But these are all very heavily subsidized by the government. So again, just like China, I don't really give a lot of credence to all these airlines like Etihad and whatever Emirates and all these, because they are all heavily subsidized by the government, by the oil money of the government. But Singapore Airlines does not receive any subsidy from the government. Again, they were
a subsidy because the government has a certain income due to its natural resources. That is why they are giving subsidy. They are not taking a loan from International Monetary Fund.
Who you are talking about? Your Etihad and all these people.
Yes.
No, that's what I'm saying. But they are not. See, 1 minute. That's not a. So what I'm trying to say is that Etihad is not a standalone success story. If they did not have,
Sir, it won't have to be.
that's not sustainable. No, it's like our Air India. The only difference between our Air India and Etihad is that Etihad is probably making money and Air India has never seen. They don't know what a profit is. Okay, so the point is that the Singapore Airlines again was not given any protection by the Singapore government. They were told you sink or you swim on your own power. Okay, they started with one aircraft, and today how did they build that brand? If you see it's the marketing success story as well. Okay, how they build that brand? They use a Singapore girl as a brand for the airline. Okay, that's all branding. Okay, why does Singapore Airlines have? You look at the business class price, business class tickets. They'll be more expensive. You look at Qantas or any Lufthansa. You look at Singapore Airlines business class tickets. They'll be much more expensive. How do they get away with it? So it's branding. It's all branding. Why do people pay extra money for Apple iPhones instead of buying some Apple or something like that? It's all branding.
So we don't have that level of literacy rate and technological development.
Why do you want to shoot yourself in the foot? Our people are sufficiently creative. What is all this jugaad business? You take a simple guy in the village, you put him in a situation where he has to use his wits to survive. He will find some ways. Indians are sufficiently creative people. Okay, but the problem is we have never put
resources as in other countries.
No. I don't agree with all these things.
Once we did free market, the British.
1 minute. What British? Huh? Sorry, what is it? What are you saying? British? British what?
I'm saying he once used to have free market policies, but then the British rule got committed again.
No, I don't know what was happening before British rule. I have not read that history. But the British rule, that's another thing to think about. Why did
they have exploited the human?
Yeah, but how did they conquer us? Think about that also. We don't spend enough time in this country because we have spent our time renaming all the British roads and all the Dalhousie Square in Calcutta as we renamed somebody. By renaming, what have you achieved? You've not done anything. You just renamed it. Okay. Sorry? What? What?
Protect our legacy.
Not legacy. You're just rewriting history. You're not achieving anything. That means you're not even learning from history. So in this country, 1 minute, guys. I think we have to stop this discussion because now I think a lot of people a big part of the class is disengaged. So we have to stop this. What happens? Sonam is disengaged. You're not disengaged. Okay, 1 minute. 1 minute. Another discussion. 1 minute. Another discussion we have never had in this country. I mean, generally you will not find in this country. We never go back and introspect. Have you ever heard anybody asking this question? Why did one truckload of Britishers come and how did they manage to control such a big country? Okay, not East India Company. They did it because they were able to set Oriya against Marathi, Bengali against Punjabi. That's how they did it. So, 1 minute. So, okay. So, 1 minute.
Yeah. Actually, British exploited Let me explain something. So British what they did because in India people are just full in the name of religion. So what they did, they found out the loopholes in the Indian. So what they did, they exploited the religion and they destroyed the United India. And it further divided into states, and they take advantage of.
I don't know how united it was before they came here, because they were already warring. Some people like Samudragupta united the country and all those things, but it was very difficult to unite. Akbar maybe united the country. Okay, guys. Okay, we're going to stop this discussion now. We spent enough time. Yes, we can't, because we can't afford to waste a finance class doing this discussion. Okay. Yes.
Sir, around 1980.
Yes.
Around 1980, India GDP and China GDP were almost equal. And now, if we compare the GDP, China is much more higher than India.
Again, much more higher.
Per capita, much higher. And per capita income, if we compare that, China is almost 10 times than that of India. Even why don't you go to China? Even though the population of China is more than India, much more. So what's the point?
No. First of all, 1 minute. Any discussion of China, you have to take a hard look and to ask yourself whether you trust the official GDP figures. I don't, certainly. Okay. So 14 trillion is their GDP. 1 minute. The US GDP is 20 trillion. Okay, after 250 years. And you expect me to believe that Chinese GDP is 14 trillion? I don't, because of what we know about qualitatively about the Chinese economy. Okay, so I don't trust. First question you have to ask is how much do you trust the GDP numbers? I would take their GDP more like 7.5 or something like that. Okay, so first of all, I don't trust the numbers. Second, China, as I told you, is 1 minute. I'm just giving an estimate. Okay, I also don't have a good basis. I'm not saying I have a great basis, but I can tell you very clearly I don't trust those GDP numbers. And if you talk to people in the market, you'll find that many of them don't. They may not say it openly because they need to do business with the Chinese government. Okay, so they may not talk about it, but nobody trusts those numbers. Okay, so that's the first question. The second is, as I told you, the way they have gone about developing their economy, the market, the government is very big in their economy. The government has a huge presence. Everything is controlled by public sector banks. Okay, so that's a very artificial economy. So I don't want to base any comparison. The only thing that matters for me for China is that China is an existential military threat to India. That's all. That's the most important thing for me.
So no trade to India.
Trade is a way of trade is also a threat. Okay, trade is also a threat. So I think that we should actually control the Chinese. We should control Chinese imports much more aggressively. But what has happened in India, you'll notice.
There you were saying that we have to
import degrees.
No. 1 minute. When I say free trade, everything is fine. But then when you come to China, there's a special qualification. For China, we have to make exceptions because that's a security threat. That's a security threat. That's only for one country. Okay, Pakistan you don't have to because they can't manufacture anything anyway. So they only make terrorists that we control separately. Okay, but China economically is a threat as well. What they're doing is they're using trade as a weapon of war. They are using trade to undermine their enemies. Okay, so that's a way also of earning money and then building up armaments. Okay, so China. So whatever I say about trade policy, when it comes to China, everything is different. You have to make exceptions because that's a number one threat to India. Okay.
Sir, what should be the ideal trade policy or ideal policy of India?
Ideal policy should be free. Policy should be free trade with exceptions like steel and aluminium, which is for defense. Because you have to understand that economic theories of free trade don't take into account geopolitical rivalries. Okay, but geopolitical rivalries are an essential part of life. For us, China and Pakistan are existential threats. Okay, so whatever we do in terms of economic policies, we have to first you have a general economic policy, but then you have to make exceptions for these two countries because they are existential military threats to the country. Is this clear? Which is why you'll notice I don't like the way that the US Indian media is very, very anti-Trump. They just mimic the US. If you look at one of the reasons, I would prefer Trump to get re-elected. Trump is the most anti-China, anti-Pakistan president that we've had since our independence. He is virulently anti-Pakistan and anti-China. So which means what? Is that good for India or bad for India? That's good for India. If I have the world's greatest superpower being led by somebody who is virulently opposed to my number one enemy, then that's good for me. So that's something you'll never see. You'll never see this discussion in the Indian media, because these people are idiots. They don't think about the national interest. Okay, I look at everything through the lens of national interest. We are not concerned, like, I don't have any value systems like, oh, this is moral or this is immoral. National interest comes before everything. So if somebody, I'm not interested in judging whether a person is moral or not. I'm looking at how can I exploit this situation for my country's benefit, to protect our geopolitical interests. We have to grow as an economy, but unless we can contain these two powers, China and Pakistan, militarily, we can't grow. You see what China's policy is to ensure that India does not get a chance to become economically prosperous. That's why they keep on troubling us with all kinds of troubles here and there. That is the policy. So
it is the thing that our international relationships are good with Trump. That's why he's acting so much anti-Pakistan.
No, he is by nature anti-Pakistan and anti-China. If you look at his policies from before, he is not. We are actually not exploiting the situation maximally. We are, if you look at India's foreign policy, I would say we are not actually maximally exploiting the situation.
We are not directly influencing, but indirectly we are influencing.
Yeah, whatever. We are trying to strike a very fine balance between China and US, but that is okay. Whatever. That is not my job. Mr. Modi was elected Prime Minister, not me. But let him decide the policy. But I'm just giving you a different perspective. All that I'm telling you is, you don't have to agree with me, but these are things that, all the stuff that I'm telling you, you will never hear from anybody else in India, because my views happen to be a minority view. But I think it's important for you to be exposed to the view. Are you following what I'm saying? Yes. I'm not trying to brainwash you with my views, but I think it's important for you to know. I think it's important for you to know that, okay, this kind of viewpoint is also possible. So you can consider it, and then ultimately you should form your own view based on your own analysis and own judgment. Okay? Like the Pangshu is very, the Pangshu is not at all convinced. Okay, guys, we've had a very long discussion, but we should not be spending the So you think this is a good discussion?
Yes, sir.
It's not a waste of time.
No, it's not at all.
Nikhil is very happy because he can continue.
Sir, we should know this more than anything.
Yes, sir.
Okay, now after shouting for so long, I was so exhausted.
Break of 15 minutes.
No 15-minute break. So now I understood what your main logic was. Actually, we should not have started this recording. So this 36 minutes of the recording will not be uploaded.
Sir, please, sir.
Interesting discussion, sir.
No, you've already heard. Whatever you had to hear, you've already heard. Okay, 1 minute. All right, 1 sec. Where were we? Okay. Yeah, tips. The whole discussion started. 1 sec. You also have to be aware, this is what is called the observing ego. Okay, part of what the observing ego does is, okay, how did we get distracted like this? Now I have to go back and think, why did we get into the discussion? Because they were talking about how to apply this theory in India, and then I said that our bond markets are not liquid and not developed. Okay, our debt markets are not developed. Correct, very good. Debt markets always, not bond markets, unless you specifically want to exclude money markets. Okay, okay. All right. I'm not sure why you. I'm sure that's not why you actually said it. You just said it. But anyway. Okay, guys. Be quiet, please. Be quiet. Now, the other thing you have to understand in this point, in this context. Okay, this is also now. Let's get serious now. Okay. So one of the things you have to understand is that typically, if you look at ECM and DCM, let's just write it here for a while. It'll just mess up your notes a little bit. So if you have this concept of ECM and DCM, what is ECM and DCM? Equity capital markets and debt capital markets. Okay, and then you have this other stuff which is ETM and OTCM. Okay, all right. So my question is, so part of the reason that the debt markets in India are not so well developed, equity markets are relatively more developed in India. Okay, NSE technology is actually very good. It's actually world-class technology. So now between these two, you have to understand this as well, that between ECM and DCM and ETM and OTCM, which belongs where? Does ECM belong in ETM mainly or mainly in OTCM?
Mainly in ETM.
And are you able to follow my question?
Yes, sir.
So what I'm saying is, if we had to connect the two pairs of categories, if I have to connect ECM to either ETM or to OTCM, not to both. And then if I have to connect DCM to OTCM or ETM, not to both, one of the two. Where would I put, which one would I put? Where would I put ECM? And DCM is in OTCM. Okay, this is something that you should also understand as part of your market knowledge, that around the world, if you look at it, okay, the debt markets historically have always been OTC, dominantly OTC markets. If you look at the US debt market, it's a massive market with all kinds of complex securities, but almost 99.9% of it, I can't even remember any debt security in the US that trades on an exchange. Everything is OTC. Okay, you have futures contracts on those underlying debt securities like US Treasury bonds, US Treasury notes, which are the underlying assets. Okay, when you have futures contracts on those, obviously futures contracts have to be OTC or ET. Futures contracts. Futures contracts are always exchange traded markets. Okay, futures contracts are always exchange traded. Okay, so the point is, when I'm saying, so remember this, that if you tell somebody that debt markets worldwide historically have always been OTC markets, okay, and what if the guy comes back to you and says, hey, one of the most actively traded futures contracts is the US 10-year Treasury futures, the futures contract on the 10-year US Treasury note. Okay, so you remember that as well. Okay, but so when the underlying market is all OTC, but when you trade futures contracts on the US 10-year Treasury, okay, which is the cash market bond, okay, that's a futures contract, so that will be an ETC, that will be an exchange traded instrument. Is this clear? Okay, but historically you have to understand that the OTC market, debt markets are all OTC. And equity markets tend to be exchange traded. Okay, there's some amount of OTC trading and equities also, but it's much less than the ET part. Okay, so and generally what has happened is that India has tended to focus. In India, you notice not a lot of bonds are made to trade on exchanges. Pretty much you can't issue any bond because unless you list it on the exchange. So in Indian regulation, what has happened is we have tended to focus regulation on exchange traded markets, and basically what has happened is Indian regulators have a jaundiced view of OTC markets. They think, because remember OTC market, which is more transparent? Which is more transparent, ET or OTC? ETM. Okay, so therefore, which is a fact. Okay, so therefore Indian regulators, because again very medieval thinking, okay, no concept of the power of free markets and innovation, and so what they have tended to do is they don't trust OTC markets because it's less transparent. So they think, oh my God, there's some shady stuff going on here, let's not allow anything to trade in OTC markets. That's been the historical attitude of the Indian regulatory bodies, and that's why and what is the consequence of that? This is the wonderful problem, wonderful situation with our brilliant economic policies which we have followed. Nobody even stops to think about the consequences, the unintended consequence. What is the unintended consequence of that, of not trusting OTC markets? Your debt markets are not developed. If you look at the size of the Indian economy, our debt markets, the development of our debt capital markets is a joke. We should have had a much bigger, much deeper, more liquid debt capital market. Why has this happened? Because our great regulators would not allow the market to develop. They basically wanted to ban all kinds of, if you look at our legislation, Securities Contracts Regulation Act, all OTC transactions are almost by default banned. Okay, so this is what happens. If you try to be overzealous, you're trying to ban everything. Oh my God, they're going to do some shady stuff. Who cares? I mean, if Goyal is going to, deceive Chabra in a private transaction, he's going to sell him a security which is not so well, maybe it's not secured. He's selling it to him as secure. And if Chabra is not smart enough to figure it out, well, let him lose money. Why should we protect people who are not smart enough to figure out, you understand what I'm saying? This is freedom of, this is called freedom of contract. Remember when we did contract law? This is called freedom of contract. If you try to interfere with freedom of contract, what will happen is you will stifle innovation. This is what people in India never think about. We think, oh my God, we might have to protect Chabra because he should not, we have to protect him.
That's not retail investors.
So forget retail. Why should you protect the retail investor? If you're stupid, why should a country waste its regulatory energy on protecting stupid people? No, nobody. Listen, 1 minute. This is how. No. If you are so stupid that if I come and sell you if you are so stupid that I come and sell you a security which is you don't do due diligence, I just come and sell you a security like a lot of people invested in Sahara and things like that. Okay, if you don't do your own due diligence, the government cannot, it's not the job of the regulation to protect stupid people from their stupidity.
Sir, how we can judge the insider what is happening in the company?
No. Then don't trade. Who's telling you to trade in that?
opportunity cost.
No, you go somewhere else. You go somewhere like, I've never touched Bitcoin because I felt there was regulatory uncertainty. I'm not sure, and then I was not sure about who these people are, although there's a lot of volatility. But I trade currencies and other stuff, but I never touched Bitcoin. Why? Because I don't want to touch stuff that I don't know. If I know that I don't know about that business, I don't know how that thing operates, I don't touch it. So if you're so stupid that because of your greed, and it's not just stupidity, it's also greed. Understand all these points, okay? It's also greed. People go and invest in stuff which they don't understand because they're greedy. So it's not the understand the beauty of the capitalist scheme. Okay, again, you don't have to believe what I say, but you should be exposed to these ideas. 1 minute. Understand how this scheme works. Okay, understand how the scheme works. The scheme works like this. You don't have over-regulation. Okay, you don't protect stupid people from their stupidity. So eventually, what happens is the stupid person loses his money, and the same stupid person evolves. Okay, it's not that the guy dies. Okay, if he has to declare bankruptcy once, it's not that guy is dead or something. He will come back. Many people come back from bankruptcy. Okay, so many companies come back from bankruptcy. So the point is, what will happen now? Chabra will come back to the economy after losing his money in a deal with you where he did not use his, didn't do due diligence. Now next time when he comes back in round 2, he is now much smarter.
Yes.
Now he's much smarter by not protecting him. Now what happened if you protected him, he doesn't have the chance to get burnt, and he doesn't have the chance to get smarter. You get smarter by getting burnt, right? Unless you
in India is too low.
What?
Literacy rate in India is too low.
Literacy rate is low. Why? Because 1 minute. Why is the literacy rate low? 1 minute. Okay, guys, quiet. Again, we are going into the same discussion. 1 second. Why is the literacy rate low? Because the government has interfered in education.
You are talking about stock market only.
Not just stock market. Any market. Fixed income. Let's say some bank manager, maybe who's going into the banks. Somebody is going into HDFC. Solanki is a wholesale banker. Some retail banker, maybe your senior Mallika. So Mallika calls him up and sells him an investment. Okay, and he doesn't do a due diligence on the investment. You understand what due diligence is?
Yes, sir.
Due diligence means you kick the tires before you buy a car. You kick the tires and see how it is. Okay, so he doesn't do due diligence. And Mallika sells him an investment and he loses money on the investment. So now because the government has not protected him, he will lose his money first, then he will sit and he will lick his wounds, then he'll learn his lesson. And then next time when he comes back in round 2, now he's a much smarter investor. Are you able to follow? Now what happens? 1 minute. These are all important policy lessons. Okay? 1 minute. If the government comes in and protects him, he doesn't have a chance to learn his lesson because the government makes it up to him. Loan forgiveness, we are doing all this loan forgiveness. You never learn a lesson. Okay, so this is what you have to understand. And the government intervention is not free. As I've shown you, government intervention has serious consequences for the economy. Like I've shown you the state of the debt markets. Okay, one of the reasons our cost of capital for cost of debt capital for companies is much higher in India than it needs to be. Okay, if we had free capital markets. Another thing that you notice, Reserve Bank of India keeps on controlling the foreign investor entry into the debt markets.
Yes.
You notice that?
Yes.
Every time we have a foreign exchange crisis, what do? Earlier you could invest 10 billion, now we'll let you invest 12 billion. This is a joke, okay? This is not the way you manage an economy of this size. This is why we are still a third world country. This is why. Because we don't know how to manage it. You just let it open, let them come. Right? Let them come and let them go whenever. If you keep the door closed, they will not come. If you want to close the door every time they want to exit, let them come freely, let them go freely. There will be some volatility in markets. But the long-term consequences of a developed debt market, you see, that's why the power of the US economy. Part of the power of the US economy, why are US corporations so competitive? Because their cost of debt capital is much lower. Right? They have a very developed CP market. They can bypass the banks, raise money in the CP market. Cost of debt capital is much lower. That makes them much more competitive. So you have to see, the problem in India is the way that we think and the way that the discourse happens in the public is nobody talks about the consequences of all these stupid regulations.
Sir?
You never see the consequences you never discuss the consequences of these stupid regulations, right? Yeah.
So foreign companies come in India and invest in India.
Yeah.
They earn income and they then the source in India and they take money back. So that it is hampering the growth of India. Now, if we taking
Why should he, 1 minute, how is it hampering the growth? Are they not employing Indians? Are they not employing Indians? Are the Indians not learning? Isn't there some kind of informal technology transfer happening? Are Indians not learning good business practices?
Yes, sir.
Google has a center in Bangalore, Microsoft has a center, Oracle has one of the biggest centers in India. I think outside the US, the biggest Oracle R&D center is in India.
Yes.
So is there not some benefit to the country? What about the local economy of Bangalore and everywhere else? Okay, and think about the other consequence, guys. Another very important reason which you'll never see discussed anywhere. One of the advantages of, just think about it, that who is our biggest existential threat? China.
Yes.
Okay, so now if you have a really radically open economic policy, if you have companies from all over the world, okay, US companies, French companies, okay, UK companies, all of them like do what Oracle has done, Microsoft. Now these US companies now have major investments in India. So do you think that if China attacks India, do you think the US is going to have some concern? Do you think they're going to have some concern because US companies have a big stake in India? They've got big investments. So that is 1 minute. Think about the geopolitical advantage of having. Sorry, I'm getting
Free economy market.
the geopolitical advantages of opening up the market. What happens is when you open up the markets, all the developed countries will come, Canadian companies, they will all come and set up base in India. And if we have a commitment to free capital markets, okay, free capital control, no capital controls, they will become embedded in India, okay. So what happens is tomorrow if China attacks India, all of these countries will have a reason to get angry because their investments, their substantial investments in India are now also being threatened. So we have given them a stake in India. Do you understand what I'm saying?
Yes, sir.
So this is a long-term strategic advantage for us as well. And we get this notion that you have, I don't know where you got it from, but it's a very short-sighted notion that foreign companies come here, they make money and then they send it back. Why did they make money? The very fact that they're making money means they're adding value to the economy.
Sir, India is a
Consumers are not fools. 1 minute. Consumers, Unilever is a foreign company.
Yes.
Okay. So Unilever is selling, they have a big market in India. It's one of the biggest operations for Unilever, India. Okay. So most of the heads of many of the heads of Unilever are going from India actually. Harish Manwani is from India. He was the CEO of, I think, chairman, a very high level appointment. Okay. Why? So you think that Unilever is making money from India and you think it's not adding value to India? Of course it's why are people buying their products? Now you may agree, you may feel that, I don't know whether they make Fair and Lovely or whatever. Now you may feel that, oh, there is no need for people to buy Fair and Lovely because it's not a essential product like milk or anything. But that's, again, this is another aspect of regulation, okay?
Sir, most of the product line of, if we consider HUL or something electronic company, most of the products are imported in China and marketed in India. They are marketed in India. So
No, but
there is no employment generation or something like that.
no, but even in marketing, you will generate some income. Part of the reason why they're making in China is that we have not created the environment. We have not created the environment for making things in India. We have to. What is the big deal? I don't understand. Why can't we compete with China on manufacturing? I don't understand it. What is the great? What is missing here? Part of the reason is our tax system is overcomplicated. All kinds of things.
Rate of interest is much higher.
No, those are all the rate of interest is not really such a big factor. I mean, it goes up and down. It's actually the environment because our government bureaucracy controls getting permits, getting this POSCO. I think it's POSCO that the South Koreans iron and steel company tried to set up a joint venture in Orissa. They were waiting for 12 years for their environmental clearance. Okay. So this is why we are not a dynamic business hub.
But sir, ease of doing business ranking has been improved from
Has improved slowly, but has improved a little bit.
Sir,
Yeah.
150 to 78.
Okay, fine. That's fine. But it should be number one or number two. It should be somewhere in the top 5.
Yes.
Why can't we make it easy to do business in India? So think about all these aspects. I don't know if this entire discussion was a waste of time or not. But so the point is, it's very important to think about many of these things which I've told you will never hear anywhere else. Okay. So think about all these aspects. So again, we got into the discussion because of some important technical financial point, which is that in most countries historically, debt markets are OTC markets. Okay, and equity markets tend to be ET markets. Okay. All right. Okay. So what were we talking about? We were talking about what? Donald Trump. No, he's actually, I've learned this actually. I actually learned this from him when he first started talking about steel and aluminum tariffs. Because I also thought that, you know, why is this guy anti? He's not free trade. He's free trade. He wants to have free trade and fair trade. Okay. But when he talked about steel and aluminum tariff, that I actually learned from him. That for the first time I realized that international trade theory, which leads to free trade as an optimal solution, does not have geopolitical rivalries as part of its initial conditions. You understand what I mean? Initial conditions in a model. If you have a trade theory model which gives you free trade is the optimal solution in the model. Okay, but in the initial conditions of the model, okay, assumptions of the model, you never thought about geopolitical rivalries. You kind of, if you think about free trade theories in economics, when I think back on it, I realized that they never had geopolitical rivalries as part of their initial condition. But geopolitical rivalries are a fact of life. You know, Russia is trying to destroy the US is trying to destroy, China, whatever, China is trying to destroy the US. So this will never go away. War is never going to end. Okay. So therefore, this is a fact of life. So there I understood the very important point he made about steel and aluminum tariffs. That if you have a war, you need to build ships, you need to build aircraft, you need to have a domestic steel and aluminum industry. You can't be even relying on Canada. They can't even rely on Canada to bring in the steel and aluminum. Okay, they have to make it domestically. But luckily, the US is a very big domestic economy, and so is India. So both of them can have competitive. If the Competition Commission does a very good job, we can ensure that we have globally competitive steel industry. Okay, but still controlling imports from outside. Okay. So these are all important considerations. So we were talking about the junk bond markets, okay, and what Michael Milken did in developing the junk bond market. So as I said, go back to YouTube and look for Milken Global Institute. Okay, there are very interesting discussions on the global economy. Okay, so financing LBOs. Okay, another point you need to understand. Okay, guys, please read this yourself. I need to rest my voice.
Yes, sir. So you can have some water.
Fallen angels. Now, after we read this, Nikhil is going to enlighten us on the difference between fallen angels and original. These are two other terms that you will hear. Remember, these terms are all important. These concepts are all important in any discussion of debt markets. So you'll understand that the dominant discussion of debt markets, credit spreads, is with reference to credit spreads. You'll see a lot of discussion of credit spreads. Okay, what is happening to credit spreads? These credit spreads, what is happening to them? Are they going up or down? Okay, we have this. This is the hopefully this is the Moody's credit spread. Okay, so be very familiar with credit spreads. Okay, we'll come back to the discussion. Now Nikhil is going to educate us on. I could ask anybody else also after. So Kalra also has to pay attention.
Should I bring water? I can also.
No. This is fine. No problem. Okay, please understand the distinction. One of the distinctions you'll have in the debt markets and the discussion is this a fallen angel or is this a original issue high yield? Yeah, read this here. No, don't worry about the Saudi Arabian bond pricing case, that we'll come to later. Okay, Nikhil, you're ready? You're not ready? Kalra, what is the difference between fallen angels and original issue high yield? You're not ready? Kalra is acting like he's sitting at a wedding enjoying himself, and I've come to disturb him. Yes.
Yes, sir. Sir, fallen angels are that originally they are issued as a investment grade debt security as like AAA grading grade or A plus grading, and later because the fundamental of company reduces or they get worsened, so the rating agencies downgrade this investment grade. So sir, it is the fallen angels.
Okay, and what is original issue high yield?
Is that when the securities were issued, they were issued with high yield, as in they were below the investment grade.
Good, very good. So this is the difference. Everyone understood what he said?
Yes, sir.
Okay. So the fallen angels are essentially securities like recently GE, blue chip name like General Electric has been downgraded, and there was some market talk. They are still investment grade, but the situation in GE has been has become so bad that they were actually talking about GE debt being downgraded to junk. GE used to be one of the iconic companies in the world. This used to be the company which was the case study for all.
When a bond is referred to as junk bond, when a bond at what stage it comes in?
1 minute. What are you saying?
When a bond is
When the bond is falling, when we refer to it as a junk bond, at what?
When do we refer to it as a junk bond?
Yeah.
This I've already told you. Who's going to answer this question? When is a bond referred to as a junk bond? Yes, Gaba?
when their credit rating has fallen.
Yeah, when it is fallen, yeah, it could be fallen, that is
And
also
their,
correct. Any bond which has a
financial condition has been worsened.
Yeah, for financial, but it has to be more specific, okay? When their credit rating has fallen, what you have to say is?
Like credit spread.
No, so the point is that you have to look at the bond rating. So remember, another feature of another feature of bond markets is that, which is where Dina is going to contribute in the future, is bond ratings, okay? So answer is junk bonds. What is a junk bond? It's a bond with a below investment grade, a non-investment grade credit rating.
Yes.
Simple?
Yes.
Okay, what is a junk bond? It's a bond with a, because almost every bond will be rated. Okay, you can't sell bonds in most markets without rating. Okay, so every bond needs a credit rating. So a junk bond is simply a bond which has a non-investment grade credit rating. Okay, so to look at any particular bond, how will you answer that question? Is it a junk bond or not? You have to go and see what the rating is. Okay, find out what the rating is, and then you have to go to this particular to find out which company rated them. Maybe it's rated by Fitch. Okay, maybe if it's rated by Fitch, you go to the Fitch table and you find out if the rating is falling under the non-investment grade category. If it is in the non-investment grade category, because the bond will carry a rating saying BB plus.
Yes.
Okay, off the top of your head, you may not remember what BB, whether it is below investment grade or above. Okay, you go to the table and then you check. Okay, BB plus is a non-investment grade rating, so therefore it is a junk bond. Is this clear? Okay. All right, so this is another point that we have to be aware of in the discussion of debt markets. So remember one thing, that the credit spreads, okay, what we saw here, these are the credit spreads. Okay, this is your BAA. What is BAA here? Let's look at it, guys. This is which company? Moody's. Okay, it says seasoned BAA corporate bond yield relative to yield on 10-year. So what is this? What is this variable we are plotting here? No. Credit spread. Can you see why this is a credit spread? Percentage. What is the scale showing you?
Percentage.
3.5 in 2016-17. So what is the title telling you here? What is the title telling you? Can you read this on the last bench, AA? No, even this you can't read this. The top part. So what is it saying? So what is this title is describing the data series that is being plotted. Is this time series data or cross-sectional data? Kalra? Time series? Nikhil? Time series? Okay. Okay, because you are looking at your watch. Okay. Alright. Now, time series data. Why is this a credit spread? Why is the narration why is the title explaining to you clearly that this is a credit spread?
The difference between the corporate and the treasury.
It is, what is this plotting? Bond yield, corporate bond yield relative to yield on 10-year treasury. That means corporate bond yield minus 10-year treasury. Are you following?
Yeah, yes sir.
Right? So this is the credit spread. Now this movement of the credit spread, today we are here, okay, this is February 9, 2019. Okay, now what we are saying is, so this is the credit spread. So you can plot credit spread. So the entire discussion, a big part of the discussion in bond markets or debt markets is on credit spreads. What is happening to credit spreads? Okay. So if you look at this, Max, so now tell me guys, when the credit spread is going up, okay, now you notice if we look at the last 1 year, okay, the credit spread is going up. So what does that mean? What does this tell us about the debt markets? The debt markets expectation about future economic performance? Uncertain. Anybody else?
Highly volatile.
Highly volatile. Yes. You are now going into VUCA.
Uncertain.
You heard of VUCA?
Yes sir.
So he's already got volatile and he's got uncertain. Okay. Is my question clear?
Sir,
In the last 1 year, we noticed that BAA. First of all, let's be clear what BAA is. Where is BAA?
Slow down in the future.
BAA is junk or not junk? Not junk. BAA is the aggregation of these three. So it is just below just above junk. Just above junk. So it is borderline, okay? But it is actually investment grade. Alright? So this stuff is moving up.
Slow down in the future.
Correct. So one of the things you have to be clear about theoretically is if credit spreads are going up, if credit spreads are rising, is everyone agreed? Is everyone okay with this logic?
Yes, sir.
The question is, if credit spreads are rising, what does that tell you about the debt market's expectation on future economic performance?
So it is going to fall into
They are expecting some kind of economic slowdown.
Yes, sir.
Is everyone clear about this?
Yes, sir.
Are you convinced?
Yes, sir.
Okay. Ridhima, you are convinced? Not convinced. Now you lost interest in the class now. Can't handle it anymore. Okay. So this means that if credit spreads are going up, what is the net impact on the bond yield, guys? If ceteris paribus, if credit spreads are going up,
Down.
what is the, if credit spreads are going up, ceteris paribus, what is happening to the bond yield? It's increasing? Bola. If ceteris paribus, if the credit spread is going up, what is happening to the corporate bond yield? Increasing? Everyone is clear? Okay, so now you see the logic.
The reason.
Why?
What is the reason?
Reason is, 1 minute, when corporate bonds are going up, which means the yield is rising, the corporate bond yield is rising. So what does that mean? Remember the connection between risk and return? When will investors demand? That means essentially what are we saying? If this is rising means ceteris paribus, since the corporate bond yield is credit spread plus
Plus government bond,
government bond yield. What? Rest of the class is also joined Ridhima, all switched off. Okay. So total corporate bond yield is credit spread plus benchmark government bond yield. So ceteris paribus means government bond yield doesn't move. Credit spread is going up. So total bond yield is going up. Okay. So that means investors are demanding a higher and higher of ITM in order to invest in corporate bonds. This bond yield, the credit spread is telling you tomorrow, if you're a treasurer, if you're sitting in the Airtel office and trying to issue a US dollar bond, if you're working in the Airtel treasury trying to issue a 10-year US dollar bond, this is the credit spread. Let's say Airtel is rated BAA. Okay, that means this is how you'll figure out how much it's going to cost you. So what this plot is telling you is that if you go into the market today and try to issue as a BAA issuer, if you try to issue 10-year US dollar debt, this is ballpark what you have to pay.
cost of
2.3 or whatever it is, 2.3.
cost of debt.
2.3 above what?
Highly volatile.
Above the treasury.
Above 10-year treasuries. So understand the importance of this. Why are we discussing all this stuff? Because if you're working in a corporate treasury, remember that capital raising is the most important job of a corporate treasury. Okay, the single most important job. And debt capital markets are very active. They're much more active than equity issuance. Okay, but companies issue debt much more frequently. Okay, at bigger size usually. So now, therefore, you have to understand how debt markets function. If you are an Airtel corporate treasury trying to figure out, okay, when should we time our bond issue? Let's do it 2 weeks later, 1 week earlier. You're timing the market. Once again, why do I make you do all these projects? Every decision you take in a finance job, you will have to take a view on the markets.
Yes.
If you are issuing now, that means essentially you are saying that we better do it now because it's going to shoot up even more.
Yes.
Yes.
Right? If you don't do it now, that means your view is it's coming back.
Bearish.
Alright? That means you're taking a view either way on the credit spread.
Yes.
Okay, also on the treasury, because if the credit spread may remain the same but treasury might go up. Either way your cost of debt goes up. Okay, treasury yields might go up. So everything you do in finance involves taking a view on markets. Okay, everywhere you have to take a view and there's no guarantee that your decision will be correct. Okay, so now if credit spreads go up, why are they going up? Why does it mean, why is Goel's statement correct? That credit spreads rising means that the debt market has a feeling that economic growth is going to slow down. Okay?
Cost of that will rise.
Because 1 minute, what happens in a period of slowing economic growth? Are you likely to see more defaults or less defaults?
More defaults.
More defaults, okay? Which means the risk of holding corporate bonds has gone up.
Very much high.
Yeah?
Very
So
high.
then, if your risk is going up, are you going to demand less return or more return? More return as an investor?
Yes.
So that's why you see that the yield is going up.
Yes.
So the YTM is going up. That means, what does it mean? That means that debt investors are demanding a higher and higher YTM to invest in those corporate debt securities. Why? Because they see increasing risks.
Yes.
Is this clear?
Yes,
Are you
sir.
following the logic?
Yes, sir.
Okay, that's why. So that means why do they see increasing risk? Because they see an economic slowdown. So in an economic slowdown, there is a higher risk of corporate bond defaults, and that's why they see increasing risk in holding the bonds. That's why they're demanding higher interest rates. Are you following? So we learned something today. Okay, other than the policy discussion.
Very healthy discussion.
You say anything to finish the class? I don't think we are done yet. Oh, we have 5 minutes.
Don't invest in
1 minute.
without due diligence.
Okay, guys. 1 minute, 1 minute. We haven't finished yet. This is one sec. This is just first class. This is just the first class. You need to discipline yourself and concentrate. Okay? Nominal, real, we've covered all this. High yield versus non-fallen investments. Okay, quickly, we'll do this case. You read this case also. 1 minute, we'll do it quickly. I'm going to summarize this case quickly, then we'll do it again. We can revise it.
Gist of this case.
So this is an actual case which happened. Saudi global bond, the biggest emerging market issue. That was at that time the biggest emerging market issue in the debt markets. Okay, so Lakshay will lose 2 points. This is what you call losing wickets in the last over. You can't hold on. Lakshay is which team? Tanvi. Gaba. Tanvi's team is. Oh wow! You guys haven't even opened your account yet. That's amazing. Your group is the highest scorer in negative CP from the last course. Okay. All right. Saudi global bond pricing. Typically, how a bond issue is managed. Okay. Typically, how a bond issue. Look at the indicative pricing. So the issuer. In this case, this is KSA. Okay, this is called KSA. KSA, what is KSA? Why am I putting KSA next to Saudi Arabia? The bond is going to be marketed as Kingdom of Saudi Arabia. Okay, the issuer. Yeah, so the issuer is going to be Kingdom of Saudi Arabia. Sovereigns are like that, most of them. Kingdom of Denmark. Okay, so when they issue bonds. So remember, when they are discussing issue pricing, it's like this. They had discussed with the investors what happens in a bond issue is you have a roadshow kind of situation. You know what a roadshow is?
Yes, sir.
Okay. You take your investor team, you take the corporate finance team, you take the investment bankers, and you go and meet investors in the major and international financial markets. Okay. Go to London, have a roadshow. In that roadshow, you call all the fixed income, all the major debt investors, and you talk to them about, okay, we want to send 10 to 15 billion dollars. We want to sell about $10 billion worth of bonds from the Kingdom of Saudi Arabia. This is what we are offering, guys. This is like a negotiation. You're opening negotiations, okay? So they go there and say that this is our plan. See, Qatar is offering whatever credit spread Qatar is facing. We are offering you 60 basis points above Qatar. Okay, so we are offering 160 basis points over in 5 years. See the numbers, 185 in 10 years, and so all bonds are priced like this. When you see a bond issue that is being priced, okay, you will see that when the news comes on the international news wires, you will see Kingdom of Denmark 10-year 5%, which is 10-year bond, 5% coupon, priced at 350 over. What does that mean? 350 over means all discussion is in terms of basis points. Okay, 350 over means 350 basis points over comparable 10-year treasuries. So because we said what did we say? Kingdom of Denmark 10-year 5% priced at 350 over, which means the final issuance of the bond is with a YTM of 350 basis points above the comparable treasury for that maturity. Since it's a 10-year bond, 5% coupon, 10-year means 10-year US Treasury. So to find out the total YTM on that bond, you have to look at what the 10-year Treasury is at that time. Okay, and you have to add how many percentage points?
350.
And how many percentage points? 3.5%. Okay, so you have to add 3.5% to the 10-year Treasury. Okay, that's how you'll find out what the YTM was on the bond issue. Okay, once he is nodding very aggressively, so that's a signal that the class is over. The class is over now. Okay, she's nodding like a Bharatnatyam dancer. Okay, all right. Okay, all right. Okay, you can go. 3 seconds.
No, sir, no, we will stay.